Thank you all for coming. Couple of, housekeeping items right off the bat. One, Josh has done a really good job here lately with taking some of the content that we've been creating and putting it out online. And one of the things that we're starting to do a little bit is taking these longer form things like the lunch and learns, like the podcasts, and trying to chop them up into little clips that we can put out. So there are a few things that I'm going to hit today that a lot of you probably already know or we've covered in the past, but this will, give us a little bit of a way to clip it. And so I apologize a little bit in advance for the repetitiveness. The other thing that I wanted to say is we're going to be putting everything up on the screen. Hopefully that TV hangs with us. We're having some tech issues with that. If it goes wonky, we'll just make it, work. With that, I'm still in the process, a lot of you probably are aware, but a lot of you aren't, of recovering from some minor back surgery. So I can't twist real well. So I'm going to try to use some of the technology on here to create pointers and stuff, but can't really turn that well to shift. So they put a spinal stimulator in my back last Thursday. So we're still in that recovery process. So the fact that we have a long weekend sitting here is not the worst thing in the world. That being said, as Josh was talking about, today is really about how working with us works. And then also we get a lot of questions about, well, how do you all make decisions? What are you looking at? Where does, your thought process come in? So hopefully talking about that a little bit. Feel free to ask questions whenever, me, interrupt me. Hopefully I'll keep those answers short, which is not my forte, but we're going to try. And then obviously any questions at the end. I did want to take a quick moment, and this is one of those things talking about, things that you all probably already know, but who we are and what everyone's role here at the firm is. I've been here obviously since 1991. I've done pretty much everything here. I don't want to do everything here. So in that process, I have a tremendous team that works here. And so I just wanted to kind of hit their roles really quick. And that way, if you have a question, you're not waiting on me. One of the things that I've found in sitting in this seat is that a lot of times I can actually be the roadblock as opposed to the solution. And so there's a lot of things that everybody here is able to take care of that you all should be aware of. Chastity, CAO, Chief Administrative Officer, pretty much anything that you actually need done that's not investment related, probably should go to Chastity first. Honestly, she's able to hit all the details and all the things that I say, yeah, we can do that, and then makes her life harder when I don't get a signature or, yeah, we can do that, but it's a 15-step process rather than the real easy thing that I just said it was. But Chastity takes care of so much for us. The investment team being myself, Brian Rummett, who's here with us, and Kaylee, the three of us form kind of that investment brain trust that are handling all of your things. So if either I'm not available or Brian's not available or Kaylee's not available, depending upon who somebody is working with, I think it's important for everyone to know that we all work together. We don't have, quote unquote, a book of business. So there's not someone, that I work with that is my client. And so no one is compensated here on their book of business that way. So if you would think about a traditional brokerage house or something like that, where, even like an Edward Jones or something like that, where you're their clients, you're not going to offend anybody if you, need to talk to somebody. One of us is on the phone, that type of thing. What I will typically do, and this is what Brian and Kaylee will do, will be to say, hey, I know you work with Brian on this, or I know you work with Kaylee on this. Here's my opinion. I'm not maybe as fully informed about your particular situation, because a lot of these conversations are long and go into very specific details. But let me get with them. Here's an immediate answer, and we'll get you a more fleshed out answer as soon as we can get to that. But you're not going to offend anybody if for whatever reason one of us is busy and the other person, can get you the answer quicker. Robert is, I guess what we landed on title as general counsel and tax advisor. So that also includes all of our state work. A lot of us, myself, Brian, Kaylee also do taxes, but Robert does the primary bulk of our tax returns, preparing wills, preparing estate documents. And so he's also our chief compliance officer. So he is very well versed with what the SEC allows us to do and what the SEC will not allow us to do. So sometimes, when we'll say, hey, I need to check with Robert on that, that's kind of, just making sure. The SEC is our chief regulator, and they're like any regulator. Nobody likes dealing with regulators, but they do forge, kind of that gap between the investor and the investment community to make sure that people aren't taking, advantage of. So we're very appreciative of that. Sometimes we have to remind them that we're an office of 7 people as opposed to being Merrill. But, we want to make sure that we're doing everything involved there. Dora, who's out front with us, one of the big things when we were hiring Dora was I think it's extremely important to have that friendly personality both on the phone and when you walk in. Because when we're dealing with money, it's not always the most fun thing in the world. Sometimes it is. But doesn't mean we have to be dour and gloom about it. And Dora does a great job of connecting us with, the people that we're working with and making sure that, picking up on those things that maybe my dumb male brain isn't necessarily attuned to, of like, hey, they were, when I talked to them on the phone, they seemed like they were more worried. And I was like, well, they seem fine to me. No, they're, we maybe need to dive in a little bit more there. And then obviously Josh, who puts together these lunch and learns, our podcast, the Bullseye podcast, all those things, does a tremendous job of taking all this content that we have and getting it out to folks. So if there's ever things that you'd like to see or messages you want communicated, Josh would be the person. So don't want to stay too long there, but I do think that that's kind of the important kind of overview of how the staff works together, and everything that we do is a team. So just like with the investment team where we don't have a book of business, if it makes sense for you to talk to Robert about that estate question, I know a lot about, estate administration. Robert knows the legal side. So if I'm working with Robert with a client, that's an important thing. And the reason why we're doing it is not necessarily because one of us isn't, qualified, but he's the lawyer. We want to make sure that we have the law involved. So everything we're doing is team-based. This one's kind of just a funny one. I won't spend a whole lot of time on it. But a lot of times we'll say, how do you say Aldebaran? And this is a reason why we're going by AFI now. But this is kind of the breakdown that I give a lot of people is it's Aldebaran. Aldebaran. Throw them all together. It works. You've heard us talk about it in the past. We've gotten mail for years to Mr. Aldebaran. And the story there that most people know is it's the ship Dad served on in the Navy. When he was, going out on his own, he got the advice, hey, you should, pick a name that's different than what's out there. He did. He blessed us with Aldebaran. This is a big reason why for a long time we went, I would call people and say, I'm calling from Don Raber's office. I mean, when Raber is easier to say than your actual business name, that's saying something. But we do like the story that goes behind it. It's the Eye of Taurus, but it's also why, and so Bullseye Podcast, that's where that comes from. We try to tie it all in. But it is why we use AFI now. Aldebaran Financial Insights, technically we're Aldebaran Financial Inc., but Insights, I think, hits the mark a little bit better. Yes, we're a corporate structure, but I don't think that really matters to what we're doing. but that's how you say it, out there. So now we're kind of going to dive into the meat of what we're talking about. And this is something I want to spend a very short amount of time on, because I think a lot of times investment advisors, brokers, beat people over the head with fiduciary versus suitability, but it is really important. A fiduciary means legally we are required to act in your best interest. That doesn't mean that we have to be perfect or that we have to be right, but we have to feel like what we're doing is in your best interests above and before our own. So it's one of the reasons why, you all probably aren't aware of it, but every single trade that anyone in the firm does for their own personal accounts is monitored. And so that's to prevent insider trading. It's to prevent, if we get together as an investment committee and say, hey, we want to buy, Eastman or Apple or whatever it is, we have to make sure that for any client that would be appropriate, they are given first opportunity at that before we buy it for ourselves. The flip side of fiduciary is suitability. Now, this is what most brokers operate under. And it's the reason why you can go to a Fidelity or a Vanguard or any one of these big box retail, wholesale type brokers, and they can recommend their own funds to you. So if I determine that the best thing for you is to own large cap stocks, as an RIA, I have to go find what the best large cap solution is for you. That might be a Fidelity, it might be a T. Rowe Price. If I'm operating on a suitability standard, I can put you in my firm's fund, whether it's the best fund or not. And so I think that's a really important differentiator of how investment advisors are different than brokers. I don't know that it necessarily plays out, from a performance standpoint, to a great degree. So the returns might not be tremendously different. That's how, you can get by with the suitability standard. But I do think it's important from a philosophical standpoint of why what we do is so important, is to be on your side and to be there, for your best interests regardless. We are a fiduciary only RIA, meaning we don't have a brokerage side. There are places that have both fiduciary sides and suitability sides. And so a lot of times you'll see that with brokerages, that they'll have the brokerage side and the investment advisor side, and they say that there's a clear line between them. I'm sometimes concerned when I see portfolios that are brought in that that's not necessarily the case, but we're required to. So that's, for us, the big thing about why fiduciary is being so important. This is something I wanted to spend a little bit of time on, of why do you work with an advisor? Why do you work with someone like Aldebaran? And a lot of times I think the confusion is we're here to beat the market. And that's not necessarily the case. Vanguard did a study, and anywhere from 0 to 3% annualized excess returns come from working with an advisor. But it is not from, I picked Google instead of Kroger. And they do a big kind of breakdown on this. And one of the things that I'm going to do is I'm going to try to break out of the slideshow here for just a second and go back. Because this is kind of small on here. And when we get further into it, I'm going to be doing this anyway, so might as well we'll try it now. But if we go and look at, once this thing pops up, where those excess returns come from. This is a Vanguard study, and it gets cited a lot. And so what I'm going to do is try to zoom in here. So suitable asset allocation using broadly diversified funds or ETF. They don't even give that a value, so that greater than 0. So on the very far right of this is basis points added. So if I added in that second section where it talks about cost-effective implementation of 30 basis points, that would mean that if you would have gotten 5% by using cost-effective things, maybe you get 5.3%. That's how the basis points work. The biggest places, though, that advisors come into place is one, cost effective. So you may be in, I don't know, because I don't want to disparage somebody. So we'll say made up mutual fund X that their internal expense ratio is 50 basis points. And I know that you can get the exact same performance out of a different fund at 20 basis points. Well, I've saved you 30 basis points. Your return will be 30 basis points higher. Rebalancing, there's a lot of thoughts on rebalancing. They don't give it a whole lot of credit. 14 basis points. So that's just the fact that, when our winners run or our losers lag, are we constantly rebalancing? And there is value to that. And knowing when to do that, can add in. These are the bigger places. So behavioral coaching, up to 2%, basically. 0 to 2% comes from behavioral coaching. So I think, the biggest thing would be, especially, and we're seeing it right now during this tariffs, keeping people in the market. I haven't beaten the S&P by staying in the market if I'm fully invested in the, S&P, but I'm not jumping out when I should. I'm continuing to make, smart investment choices and being disciplined. That actually adds a huge amount to people's returns. And it's one of the reasons why when you see these studies, individual investors lag the market constantly. And it's because a lot of what goes on in the market isn't intuitive. It doesn't necessarily make sense when you just look at it on the top line. And so that's our job, is to make sure, well, what you're doing, does that make sense? Is that keeping with the plan that we put together when times were calm? Are we not overreacting when times are either jubilant? So one of the things, I would say this works on both types of markets, negative and positive. It's very often that we'll come back to people, and let's say you've got 50-50 portfolio, 50% bonds, 50% stocks, and the market is going gangbusters. And someone will call up and say, well, why would I own bonds? They're only paying me 2%, or, at the base of COVID, they're paying me less than 1%. Why would I continue to own those? Because you never know when something like this tariff situation is going to come up, or COVID, or something like that, and then you lose value there. So being aware behaviorally, on the positive side as well as the negative side. Asset location, this is a big one that's not talked about a lot, but are the things that should be owned in IRAs owned in your IRA? Or are the things that are owned in your taxable accounts owned in the right places? A lot of times, I've worked with a number of people to say, look, we want that account actually to go to zero because we want this other account to get all the growth. We want the Roth IRA to get all the growth, right? So then we want this other account to spend down to zero. And that's not intuitive to a lot of people. Well, why would I want my $30,000 account to go to zero, by taking all my monthly distributions out of there? I've been able to keep that account constant for X number of years. It may not be the best thing from a tax perspective. And sometimes those tax benefits take 7, 10, 15 years to come about, but they do come in. So that's a big thing. And that's part of the spending strategy, withdrawal order. A lot of times people will call up and say, I need $5,000. Can I get that out of my IRA? Because I don't want to sell something that's in my taxable account, my individual account. It might be better to sell the thing in the taxable account, distribute from there, and change the investments that are then in the IRA. So those are things that don't often get talked about when you talk about, well, why am I working with an advisor? If I was just going to be in the market, can't I do that on my own? Absolutely. It's a lot of these other little decisions that add up to big numbers down the road that are the important part. And that's a big thing about why working with an advisor makes so much sense. And that's a Vanguard study. It goes very in detail. If you went to that article, you can look it up. There's a lot more that goes into it. But those are all things that I think make a big difference. A a lot of times the other thing that I think that we're really good at is reading between the lines of, it's not uncommon, for people to say they want one thing and really want something else. Or their actions have told us over time, hey, they're going to call up and need distributions, on a consistent basis. But in the meeting, I'm a long-term investor, I'm never touching this. Well, over the last 3 years, every quarter we've taken out X amount. So we need to plan for that. If I knew we weren't going to take it out, yeah, it might be a completely different investment strategy, but I don't want to get hit by unintended costs by not planning for it. So those are things that working with an advisor, I think, are really important to realize where that value sometimes comes in. This is a big thing, and we're fighting it right now. And a lot of advisors will put this out there, but the cost of missing the best days. So if we look at this, this is where I'm going to try to do one of my laser pointery things. So $10,000 invested in the S&P. This is 2003 through 22. If you stayed in the S&P, that $10,000 grew to $64,844. If we miss the 10 best days, that returns only $29,708. But here's the big part. 7 of the 10 best days took place in bear markets. And so down here on the bottom, when we look at this, 2008, 2020, that's COVID. 2020, that's COVID. 2009, we're still in the Great Recession. 2020, April. 2008, 2009, 2008. So it depends on where you define bear market, but none of those dates are great. But the problem with selling out of a market when things are bad is you got to be right twice. And so everything that we do is based upon kind of this data that's built up over, well over 100 years of market data of how do we get to the best results. And a lot of time getting to the best results doesn't feel good in the moment. And so incrementally, you miss 20 days, 30 days, 40 days. If you miss 60 days, your $10,000 has dropped, to $4,205. I've told a lot of people this, but if I could go back and buy in October of 2007, right before the Great Recession, I would put all my money in. Hindsight 2020, right? We would then go on to lose 50% by March of 2009. If I could put it in all in March of 2009, absolutely. I would rather have put it in there. But if my options were being in right before a big drop, I'm going to still take the being in before the big drop. The thing is knowing our time horizon. If I need that money tomorrow, it shouldn't be in, right? If I need that money in the next year, shouldn't be in, to the extent that I can't afford to have a market correction like we're seeing right now. Every year we get 10% corrections. Every year we get, the potential for a big correction of 20% or more. Traditionally, that's where a bear market is defined as 20% from the top. So that's something that we work with a lot of saying, yeah, right now it's scary. We don't know when this tariff situation is going to end. But what I do know is that we have 100 years plus of history of the market being undefeated at getting back to an all-time high. So it's weathering those two things is a big part of it. This is another way of looking at it. So 20 years of $2,000 in new money every year. So this is, if you were given $2,000 every year, how would you do? If you had perfect timing, so that in this study was defined as buying at the lowest point of any year. Now you're allowing your previous to just continue to ride. After you bought it, you're still in. Yeah, if you have perfect timing, have it. I don't know where we can necessarily find that perfect timing, because for some reason, The market is extremely irrational in the short term and rational in the long term. Column B is if you invested on the first trading day of the year, every year. So we're giving up 12 grand, not insignificant, but my likelihood, the ease of doing column B is a lot better than doing column A. And because we're math nerds a lot of times in this profession, we take the probabilities where we can get them on our side. Investor C is the worst timing of the year. You bought at the peak every single year. The perennial, I bought it and then the market went down. Over time, that still works. So if we look at $2 grand of new money for 20 years, that's 40 grand. All right, I still made $101,000, even being the most unlucky person in the stock market. Compared to investor D, they bought treasuries and T-bills, and that's all they ever bought because there was always going to be a better market. So they never get it. So they're 40, interest still works, still compounds, but it gets us only to 63,000. So a lot of times the things that keep us and hold us back as investors and where it's our job to work people through their portfolios is overcoming that, perceived missing out, the FOMO or whatever you want to call it, and just working the plan. Because the plans work. It just sometimes, we have to stomach some of the bad to go along with the good. This is an interesting one in why, when we get into the Aldebaran process, why we spend so much time on the front end working with people to come up with the right asset allocation. 90% of your results come from that allocation. This was a study done back in 2005. I'm sure you could argue with these numbers and move them from 90 to like 85 or whatever it is. The bulk of your return comes from knowing up front, I should be 70-30, or I should be 60-40, or whatever it is. The sticking near those allocations over the long term dictates your results. So security selection, that's 5%. Timing the market, 2%. So, like we saw column A versus B versus C, market timing definitely plays into it. And then other factors, a lot of times that's spend rate, that's, unexpected, events within the market or within personal lives that change your results. But 90% comes from your asset allocation. And so when we look at asset allocation, this chart, it's really hard to read sometimes. But basically what this is from 2009 to 2023, each one of these quilt patterns represents an asset class. So the red is international emerging markets. That light blue is mid-cap. Dark red, international developed. Real estate, large cap blend, small cap, diversified portfolio. I'm sure it's probably a 60-40 for this particular chart. Depending upon where you get this chart from, a diversified portfolio can look very different. Commodities, bonds, cash. And so if we were to look, the return since 2009 to 2023, U.S. large cap is 13.97 in the best place. Commodities are actually negative. But this one over here, this is the risk. This is measured by standard deviation. And so real estate, there's roughly a 20% band there on returns. And that makes sense. So, some years like 2010, real estate, number one. You got 2 years from 2020 and 2022, real estate, the absolute worst. And that's why you can see this kind of line of the diversified portfolio, is right in the middle. So that's why a lot of times when we talk to people about what their investment expectations should be, diversified portfolio of 7.7%, but the risk is one of the third, it's the third lowest here. It's 9.71. So a lot of times it's hard for me as an advisor to look at someone and say, especially in, we've got some real estate agents here, so I pick on them a little bit. Real estate can absolutely outperform the stock market. So I can't sit there and tell someone sitting in my office who says, well, why should I put 100,000 with you when I can take 100,000, put it into, a home, let's say it's a down payment or whatever it is, allow the market to appreciate, I'll have a tenant who's going to pay me. Do it, but the risk is also here. And so a lot of times that can be, I can't sell it when I want to, or unexpected HVAC problems in the property. I can't find a renter. There's things that are risks there, just like there's pros and cons to every single one of this. It's our job to look at someone's situation and say, well, how do we get you to your desired goal with the least amount of risk? That's how I'm always viewed it. How can I get you there with the least amount of risk? And so when we're looking at asset allocation, obviously a lot of things that we do are stocks and bonds. There's a few things that we'll take into consideration. So if someone does have that real estate position outside of us, I'm not probably putting you in extra real estate in what I'm doing. But this is kind of a good breakdown. So this is 1926 to 2022. This is a long period of time. So what you have is basically all bonds on the left to all stocks on the right. And so you can see these big swings. During that time period, the best calendar year return for stocks was 54.2. The worst was negative 43.1. These white dots in the middle are what the average returns have been for each of these portfolios. So on average, and this is why we say this when we're putting someone's portfolio together, of saying, 5% in bonds. We used to get a lot better in bonds. We've gone very low here lately, and now 5% feels great. We've had periods of time where we could get 10% in bonds, but right now, 5%, especially coming off of low interest rates, that's not an unrealistic expectation as an average. 10.2 on stocks. Since 2009, the S&P 500's up, we'll call it 13% after the carnage that we've seen, to start this year. But on a 15-year average, the old number was 8 to 10, depending upon, we've had an exceptional run driven by 7 stocks and the tech sector and the AI revolution, everything kind of driving things higher. But on average, let's call it 10% in stocks, 5% in bonds. We have 50-50 portfolio, we're at 7.5. That's kind of where those things come from. To me, that's still kind of abstract. So what I look at is, if you took 10% with those annual compounded rates from the averages, what does that get us to? 100% stocks over a 20-year time period gets us to $70,000. 10,000 in bonds gets us to $27,000. So when I'm looking at doing that, I'm going to jump forward because one of the stocks kind of still I've got duplicate there. What I'm doing a lot of times is I'm listening to someone and saying, okay, well, what return do I actually need? And this is kind of a back of the envelope way of doing it. There's, we've got more complex software to do this, but I thought for today it would make sense. A lot of times when we're looking at someone's retirement, and we'll say, well, do I have enough money to retire? Maybe. Depends on your lifestyle, right? But we start with generalities. In general, most people spend about 80% of their take-home pay in retirement. So in this situation, if you were taking home $100,000, you're going to spend about $80,000. It's a rule of thumb. You could retire and spend more. You could retire and spend way less. It just depends on how you want to live your retirement. Your average Social Security, $19,000 a year, right? Give or take. Obviously, we've got people in our area who are making a lot more and a lot less. But that's the average. So then we work with a person and say, well, what's your Social Security look like? You can look it up online. But that means we need $61,000 from our investments to get to that $80,000. Right? Well, if I've got $1 million in my account, What sort of return do I need? I need 6.1. If I go back to my chart and say, well, where does 6.1 come in? I might only need to beat 20% in the stock market to get to that type of return. Well, why would I go to an investment advisor if I'm not going to be in stocks? Well, because right now, especially this year, it would feel a lot better to be 80-20 than it would be, or 20-80 than it would be to 80-20 right now with what we've seen happen in the stock market. So it's planning that out and saying, okay, well, how do I get there? And then what we'll do is, if I had a 6.1 rate of return and a 6.1 withdrawal rate, my $1 million stays at $1 million forever. I'll pass down $1 million to someone. But if I'm only able to get 4% returns because the market doesn't do well, or my 80-20 or 20-80, whatever that happens to be, doesn't perform as well, how long is that $1 million going to last? Well, in this case, you go out to year 30, we still got 517 left. I'd rather have $1 million. But if I walk out of here and I'm able to pass on $500,000 to my heirs, that's, for a lot of people, that's where we're at. If we've been able to save $250,000, right? All of a sudden, I need 24% return to live my lifestyle. Well, I even earning 10% return, make this a little big. I run out of money. Still, I can make it to year 30. I've still got $8,000 on a mill. Got to change all my numbers. $250 up here as my starting point. I run out of money very, very quickly because instead, that's 24% the first year. But if I needed to take that on down and say that was going to continue to withdraw $61,000 a year, I run out of money year 5. That doesn't work. Most people plan on living more than 5 years after retirement. So we either need to withdraw less, or while we're alive, the flip side would be, at age 45, 50, whatever it is, kind of doing some of those long-term projections to say, well, what am I going to need at retirement? To have $80,000 and to have a realistic retirement where you're able to continue to save or continue to distribute 61,000. So if we go back, say, well, it's 750, what sort of return do we need? So let's call this 8.1. Let's say we get that standard diversified portfolio of 7.7. 750 still leaves us with 662. Okay, well, what do I need to do to get to 750? Well, I have to withhold X amount from my paycheck. I have to have this sort of investment portfolio during my lifetime. Those are the things that we're doing as investment advisors when we work with our clients to try and get best guess numbers. And then when something weird happens next year, job change, unexpected, medical expenses or whatever, we adjust these numbers and we move around. But these are the ways that we're working with clients to try and get us as close as possible with the least amount of risk to our investment goals. We have some people who come to us and they don't want any of this. That's not what we're there for. It's not uncommon for someone who works with us to have another financial advisor because, don't put all your eggs in one basket philosophy type thing. Okay. All right. Well, if you're doing XYZ with other advisor, what are we doing? It might be we're only providing the fixed income return. Okay, well, how do we get there with the least amount of risk? Then we're looking at interest rates and bond ratings and everything else. So there's a myriad of different ways that we adjust this to kind of come up with what's the best portfolio for someone. You may or may not have seen things like this. I don't put a lot of stock in these. This is something that Charles Schwab puts out. People that we custody people's funds with. It's a questionnaire on what my risk tolerance should be. And I just wanted to spend a few seconds on why these questions are so dumb.
Let's just build it.
I plan on beginning withdrawing my money from my investments less than 3 years, 3 to 5, 6 to 10, 11 years. Maybe. Once I begin withdrawing my funds, I plan to spend all the funds in X number of years. I have very rarely found numbers of people who can accurately answer those questions unless they're already at the point of retirement. If you know you're retiring next year, or in 3 years, I've got a contract that ends, yeah, we can narrow in on that. But very rarely can we come up with that. So this comes up with a time horizon score. And then they're like, okay, well, what's your risk? I would describe my knowledge of investments as none, limited, good, or extensive. If it's none, that's not a bad thing, but this questionnaire would make it so. You focused your whole life on being an engineer, a doctor, a teacher, or whatever it is. That should be where your knowledge base is. It's our job to help with that. Our knowledge of investments is extensive, right? So how do we play that out on someone's risk tolerance? What amount of financial risk are you willing to take? Lower than average risks, expecting to earn lower than average returns. Well, if you don't know what the risks are and you don't know what the returns are, how do you answer that question? Well, if you don't know what average is. Investments you currently own or have owned. Stocks are on there. Well, what if you've owned Tesla? It's the only stock you've owned. What if the only stock you've ever owned is Verizon? Well, they're two dramatically different investment profiles. If the market dropped 25%, what would you want to do? Sell all my shares, sell some of my shares, do nothing, buy more shares. If you haven't worked with someone or don't know how the market necessarily works, how can you accurately project that? Review the chart below, and it's, best case, worst case scenarios. This is probably, of everything, the one that I think has some value, So if my average was 7.1 with the best case of 22, worst case of -9, it's pretty different than 10.2, 3.9 and 3.6. But if you don't put those in real dollar terms, the difference between 7.1 and 10.2 can be massive over 20 years, And so that's kind of, that's why these things that come out of, and then they put you in this. So across the top, that's your time frame. Time horizon on the left side, sorry. Time horizon here, risk up here. And then they throw you into one of these buckets. All right. Pretty big buckets. But this is how our industry tends to work, or when people who are trying to do it on their own and go online and try to find, well, what should I be? This is what they come up with, and it's why so many people have a negative experience with the market. And so not a great way of doing things, but it's something that you see a lot in our industry. This gets a little bit more into model portfolios, and a lot of you have heard me talk about why we don't like model portfolios. Sure. Model portfolio, simplest way of explaining it would be, especially nowadays, like a Vanguard 2050 fund. That's a model portfolio. In that, regardless of who you are, this is the model, and this is what you will buy. There's a lot of problems with model portfolios and they're a reason why we don't use them. But there are some positives. They're simple. They are diverse. You're not going to get hit by not being diversified. They typically are cost effective in that they're using funds that have low expense ratios or whatever it is. They save you time. I have to make one decision. And so you have time-based ones. You also have the moderate portfolio, the aggressive portfolio, the conservative portfolio. Mutual funds have been doing this for, decades. Here's one of the biggest things that I have both envy of, but also detest a little bit, scalable. So if you're someone like us, infinitely more scalable to put all of our clients in one of 7 models, right? I only have to make decisions once. So that's a good thing from our industry. So you've got more time to spend working with people individually. So there's benefits to it being scalable for a firm like ours. But here's where I've got problems. Limited customization. I'm going to run through these, real quick. Contribution levels, lack of control, alignment with investment objectives, time horizons, tax considerations, and they do tend to chase performance. What all of that boils down to for me is basically there's not a single client that we work with that doesn't come in here with their own particular set of circumstances. And going back to suitable versus best interest, I've yet to see a model that is in someone's exact best interest that I couldn't make better by customizing. That might be, hey, I own stock in, a lot of our more established, longer-term clients will remember this, but how long did we own First Horizon? Forever, because we had Home Federal in Johnson City bought by First Horizon, so we had a $2 cost basis, and the thing was trading at $40 a share. If I need to put you in a model portfolio, I've got to sell that to meet the model. There's very few models that are sitting there saying, yeah, you should own 50% of your portfolio in that. Now, if it was something that you didn't put a whole lot of money into, it's grown into a big thing, we're living off the dividends, we're okay if it drops, well, that doesn't align with the model, right? So why should I pay, 10, 15, 20% in capital gains just to make your investments match my model, if that's not the best thing for you? So I will say most of our portfolios rhyme. You're not going to see dramatically different positions in any one of our portfolios, but nothing that we're doing is exact. And there's very extremely, I think, rationalized reasons behind that. The other thing would be, a lot of times people come in and say, I want to own XYZ, whatever that company is, for various reasons. Might not be my favorite, right? But that's not my job necessarily. My job is to facilitate what you want. And so, whether it's so-and-so told me and I think I want to be in this because I trust that person, my job is then to adjust the rest of your portfolio to accommodate, right? Or, I have a low cost basis on that stock. I've got to pass that on to my heirs. So that means we have too much if it's First Horizon. Maybe we don't own another bank, right? I like JP Morgan better. Okay? But that's not, I can't change the model, because as soon as we start changing the model for one person, then we don't have model portfolios, right? So anytime you're looking at models, yes, they can work. They get you, 90% of your investment returns come from asset allocation. Most models are an asset allocation strategy. But there's reasons why we don't use them. A little bit more on how we work, and I won't recognize the time because Josh will yell at me. We start just a skosh late, so hang with me. But if anybody needs to leave, feel free. We're in the process of formalizing this, but this is functionally how we've been doing things since the beginning. How we pick stocks. There's positions out there that we view as core holdings that work for everybody at pretty much any price. So if you were to think about Apple, for most people, that's a core holding. Tariffs might change that. But right now, let's consider them still a core holding. We think they're good for everybody, right? Now, maybe not every core holding is in everybody's account, but we feel like the story is strong enough. They've got strong management. They've got strong earnings. The risk profile is right that they can work for pretty much everybody. We've got ones that we're willing to hold, right? These are ones that maybe they don't have a growth catalyst right now, but either they were core holding and they're, have no longer started growing the way they were, but we still think that they're a quality hold. So if you were to look at, although lately with what they've been doing with their AI technology is move them back from hold into core. We used to think about like Walmart, when they hit a massive size and then, they were kind of that bloated big company, they were still going to do what they were going to do. Their profile made them still a quality hold. We've got stocks that we're reviewing. Are they still a hold? Are they in, a new position? Are they somebody that we need to really look at? One, this is on today's screen. United Health is getting crushed today.
Wow.
United Health is down about, 20% today? They came out with some news where the, Medicare reimbursement rates and some of those type things are driving them down. They're normally a pretty good indicator of why other insurers do what they're going to do. Well, whenever something like that happens, they immediately go on our review list. Are we willing to hold through this type of thing? Nobody knew coming into today's trading that they were going to be down 20% today.
And
MetLife's up, exactly. So they immediately go into review for me, Kaylee, and Brian to say, well, do we still feel comfortable holding that? Are we looking now for an exit point? Or are they going to be fine once we get past XYZ? If there's something going on government-wise? Those are things. And then you've got ones that are immediate exit. So I would add a fifth category of client holds. That's something that we do a lot. That's not a position that we necessarily like, but we hold it for a client, so we still monitor. But exiting stocks, ones that are management changed, or, it'd be pretty, trying to come up with, we'll say unwise instead of stupid.
BlackBerries.
Right, is BlackBerry still the main thing? I was going to go with like Enron. The story changed on Enron, and we needed to get out of that. So there's ones that we're evaluating constantly for immediate exit, and so because we work as a team, we have kind of a formalized process of going through these things. But if something happens on a daily basis, we're going out and talking amongst each other and talking with clients and talking with in our investment group and saying, where do we need to be that? And that's in that how do we monitor? So we have a weekly investment meeting that we go through. We talk about these things.
Okay.
Anytime earnings hit, news hits, price move triggers, we've all got things on our screens that are popping this up. Doesn't mean that we're going to make a change, but we're monitoring. And I think one of the things that that we fight a lot from a perception standpoint is that and the media does this a little bit, are you buying and selling? This XYZ happened on the market today. Are you buying and selling? Hopefully, if we've done our job right, no. Being perfectly honest. If we've done our job right, we got the plan right on the front end, we might be making tactical shifts a little bit, but not outright selling. So like I said, United Healthcare happens this morning, drops 20% on the open. I'm not going to go in and sell it today. We're going to take our time, evaluate, see if what we need to move. It's got a nice gain for a lot of people, so we can't just sell it. If we were a mutual fund, yeah, maybe, right? But people have tax considerations that need to go into that. So yeah, it might be down 20% today, but if it's up 150% from our purchase price, is it worth taking the tax hit? So we're going through and doing those things. And that kind of comes into why do we sell? Strategy has changed for that business. Better opportunity available. I still like that stock, but I like this stock better. So I think a good example of that would be Johnson & Johnson versus Eli Lilly. The weight loss drugs, and they just had really good news on weight loss drugs today, and how they're being used in pill form for diabetes out of Eli Lilly. It's a better opportunity than maybe Johnson & Johnson's low growing healthcare stock, right? I haven't changed, being in healthcare, but there's a better opportunity available. And tax loss harvesting. And that's kind of one of those things where a position is too large. So as we get too big in a position, we'll look at selling. And the tax loss harvesting is a big thing. And this is one of those places that we add, I think, a lot of value. One, because we do people's tax returns. We know how badly some of these things can affect somebody. But the role of tax is significant in an investment portfolio, and we're always keeping an eye on that. In that, when do we sell? How do we sell? Might have a lot more to do with your tax situation than the fundamentals of the companies. A lot of times people will call up and say, "This emergency just happened. I need $10,000." Right? I didn't want to sell anything coming into that day, but now I have to come up with $10,000 to sell. Taxes are going to be the first places that I look on doing that efficiently. Maybe I'm taking a gain, but I also need to offset it with a loss. So we work both in-house when we prep tax returns, but for the clients that we can and they're willing to, we'll work with outside tax preparers to say, what's their tax situation going on? Do they have carry forward losses that we can use? Because it really is, it's not what you keep, or it's what you keep, not what you earn. So, we'll do that on the fixed income side. Municipal bonds, and this comes back to being a fiduciary, right? The yield to maturity on a municipal bond might be 5% or 3%. Might be just as good as a 5% CD because after taxes, it's better, depending upon your tax bracket. Now, my portfolio that I'm judging against, the aggregate only went up 3% and the bond market's up 5%. But net, what you kept is better. So that's something that we're looking at constantly. I'm going to end this slideshow. There's a question thing after this. I'm just going to show real quick because I thought people might find it interesting. Something that these are the things that I look at on a daily basis. So whether it's CNN or CNBC, I'm always looking at pre-market futures. What's the market going to do that day? I'm looking at this at like 5, 6 o'clock in the morning. And normally, when we're in markets like this, I'm looking at right before I go to bed to kind of get an indication of where we're at. Public news sites, whether it's Yahoo, whether it's Morningstar, we're pulling all that data in. This is something that I use a lot. This is FinViz. These are all publicly available. I'm showing the publicly available ones. We have things that we have access to elsewhere as well. This is kind of a fun one. This is to visualize what's going on in the stock market. This is the one-day performance of the S&P 500. So green. See if it's still green when I refresh it. So NVIDIA's down 2%. United Healthcare, here's that down 20. This can be a really good way of seeing, okay, well, what's going on in the market that I need to be aware of. You can change FinViz from one day to a lot of different things. You can look at year to date. Year to date, everything looks kind of ugly. Tariffs are down, driving everything down. You look at the 1-year performance, though, and we're back to green. So it can be a place to kind of visualize where are there sectors in the market that are doing, well or badly, so that when we're in our weekly investment meetings, we're looking at where should we be potentially adding or subtracting. They also have one, and I like this one a lot. This is a group bar chart, so you can look at it by industry, and you can kind of see, instead of looking at individual stocks, you can look at, by industry. Technology and consumer cyclicals are what's gotten crushed. We've had a rotation here this year as we've worried about tariffs and interest rates and everything else. People have gone defensive. Utilities, consumer defensive, materials. Those are the only things that have done well this year. Doesn't mean that we need to pull all of our money into it, but we need to be aware of it. Other things that we're constantly looking at, this is Econo Day. These are all the different potentially market moving economic reports of the week. So whether it's, today was housing starts, manufacturing index, gas reports. We're always aware of these. Like I said, it doesn't mean that we're going to make a change based on, but when we see trends, that's where we're at. We're looking at bond rates. We're looking at currencies. I don't like crypto, but I'm aware of crypto. We're looking at commodities, what's going on there. These are all things that we're constantly looking at to inform our decisions on how we put people's portfolios together. So I'm going to pause there, and then I'll open it like I said, for any questions that people might have. And I think if I could leave people with one thing, it would be that because it's your money, it has to be right for you. It doesn't have to be right for anybody else. That's our job, is to match what's right for you to what's your money actually invested. I'll pause there.
Question.
Fire away.
Your Excel spreadsheet.
Yes.
Mentioned taxes.
Right.
Are those withdrawals already taxed, or is that free tax?
So it would depend. And so in looking at that,
If you sent me a
version of this, right?
I was going to play with it, and our Roth info, and
Right.
really, basically what I've got right now is pretty much all IRA, and most gets taxed.
Right. So this one would be if everything was in a taxable account. We've got other ones that are exactly kind of what you're talking about. And it might be that I've got 250 in my taxable account and 500 in my Roth. And then we'll figure out in this scenario, okay, well, if they're taxed, if I need $61,000 from investments, what is that? That's pre-tax, or that's after tax. Well, how much do I actually need, for that to be? So this would be, yeah, exactly, from a Roth or whatever it is.
So, because your current take-home figure, 100, is
Right. So if you were if you were in the 20% tax bracket, I would change this number from 61 to 76.
okay.
Right. And so, we would be kind of shifting these around. Let's see. Now I've got other ones that are just not on this machine. Tax rate. 20%. So then I would equal this divided by 0.8. So I need 76. So now this number divided by that. Okay, now I actually need to earn 10.17. And then I would add another column in here for taxes being paid.
So you've got leverage.
Right. And what I normally do is I create them for the person. Because, like I said, very rarely do people have the exact same setup of accounts. I might have a Roth with 20% of my assets, and then a regular account with 40, and then individual, account here. Or I might have, instead of Social Security being my only form that's not coming from investments, I've got rental income, or I've got a pension income that's coming in from, especially in our area, got a lot of Eastman retirees, Kodak retirees. So we have Social Security, we had a defined benefit plan, we had XYZ, and then what we need from investment. So we customize this then to what does your situation look like, and how do we come into how much we need from our investments.
My son talking about that autopilot, the Schwab's, as they're working on having this up with all the pilots that works with Schwab's.
So what we're seeing is kind of similar to model portfolios as AI is coming in, as we were calling it robo-advisors there for a little while. Depending upon the portfolios, autopilot, they're going to want you to do it through the app, will basically alert you and say, hey, this portfolio that you're following has made these changes. You need to go into your investment account and make those changes. Whether it's Mint, Robinhood, autopilot, any of these, there's ways to, everybody's trying to find the best way to follow the market and to make the changes. This is not that dissimilar from what we used to see a lot of time in investing clubs. You used to have, an investing club in your local area. We still have them. And together they get together and they decide, okay, well, the best ideas are X, and then they go and execute individually. And so it's just another way for individual investors who are working with someone like us to kind of try and get to the results that they want. And like I said, the biggest downside in that is this knows nothing about your personal situation, right? And so that's our job really as an advisor, is to know your personal situation, know what's important to you. Something like this might shoot off that, you should buy this company, right? Whatever that company is. But let's say that company, and I've done this before. Let's say someone's father or mother died of lung cancer from cigarettes. This might shoot out that you should buy Altria or Philip Morris, right? Well, as soon as you don't buy it, it no longer aligns with that model, and it doesn't work, right? Or it's not one for one. Then you're sitting there trying to, okay, well, autopilot told me I should buy this. I'm not willing to buy that. How do I adjust for it?
Yeah.
And that throws off the entire allocation. So it is a way of doing it. And like I said, I think, in our industry, in the next 10 years, you're going to see people go online. They will talk to ChatGPT or whatever the version of ChatGPT is. It will shoot them out an investment portfolio that then they will go and buy. That part of our industry is getting commoditized. But none of that is what Vanguard's talking about our value is. And so that's where our job, honestly, if I could go back and do college again, I would get a psych degree. I'd still need my econ degree, but I probably should have a psych degree. Because that's much more important in your actual results. And a lot of times autopilot, and you see these strategies all the time. Right now, a big one, is to invest like a politician. How much are we seeing in the news cycle right now? And there's actually ETFs out there, funds that you can buy that will invest like Democrats or invest like Republicans. And it goes and looks at their publicly issued trades and then tries to follow them. I will say that there's a lag there. They report them, but it's not like that day. So you're hoping that whatever bill they were trying to get in front of, that your investment still happens before that. But a lot of times their investment happens, then the news comes out, and then, you're not right. You're buying it after they've already made their money, right? So that's what things like this, I think, are trying to accomplish, is the democratization of investments. Hey, and I'm all for it, because we've gone from where all the investment knowledge was held in the investment banks in New York to now everybody has access to pretty much everything. Now, I will say they still have their advantages. They still get information first. And it's one of the reasons why I don't really believe you can beat the market necessarily, but you can beat what your performance would have been by making smart decisions. So if someone had come to me, it's called 2009, base of market sell-off from the Great Recession, and said, I want to buy my entire portfolio, I want to buy Apple. I would have tried to talk them out of it. Fiduciarily, that is not the right decision to make. Would have they made way more money doing that? Absolutely. But the risk is there that if, for whatever reason, Tim Cook, in his succession of Steve Jobs, had gone the other direction, could have gone, completely different. One of the things that I look at a lot, see if I can find it quickly. In 2000, Palm Inc., so Palm Pilots, who still has their brick of a Palm Pilot, had higher market capitalization than Apple, Amazon, Google, and NVIDIA combined. Wow. That's not that long ago. That's 25 years. And so what is valuable today, in 2000, if someone had come and talked to me and said, hey, I want to put it all in Palm, it's the best stock, in the tech sector, I couldn't argue that they were the best tech stock, but I could point to this and say, over your investment time horizon, fiduciarily, there is a chance that that's not going to be the best thing for you. And in this case, I would have been right. In Apple, I would have been wrong. Doesn't mean that in 5 years from now, somebody else has knocked them off. It's amazing how quick some of these companies can get knocked off their perch. And that's why what we do on a weekly basis, on a daily basis, is so important. And so when one of these things happen, kind of extrapolate just a little bit, it's Brian's job, it's my job, it's Kaylee's job. Say, okay, that news story happened. Who do we have that owns that stock? Are they somebody who needs to be contacted? Is that somebody that I need to make the decision on my own? Is that somebody who that level of risk no longer works with their portfolio? And then that's our job to kind of disseminate that information to the people that we work primarily with. Or it might just be, okay, we know it. See what tomorrow brings. And that's why what we've tried to do here lately, a lot of, is, like those emails that I'll send out in the morning, hey, the market's doing this. Broadly, there's not a lot to do when you have something like this tariff situation going on. Broadly, there wasn't a whole lot that you could do when COVID was happening. So if we go back to COVID, I was sending out emails pretty consistently to everybody working with us saying, in the history of pandemics, this is what the stock market has done. If you could get out and then get back in at the exact right time, absolutely, you would have beaten what we did. But our clients who were able to do the best, especially with how V-shaped that recovery was to hold through it. Problem is, you just don't know, hey, I lost 1,000 points on the market, lost 1,000 points on the market, down 500 on the market. Hey, the death toll is going to go to X. Doesn't that mean that portfolio should be? All we have is kind of, history is not a, what's the disclaimer they make us put on? It's past performance is not indicative of future.
It can.
But history does have a tendency of giving us some pretty good clues about what we are going forward. Now, if coming into COVID, you were retiring in 2021, hopefully we didn't have you 100% in stocks, right? Or at least we had the conversation of this is a risk. Looking at today's, coming into today, if you're retiring next year, you probably shouldn't be 100% allocated to stocks. We're down 10% year to date on the S&P 500. Not 10% from the highs, completely different story. We're way off the highs. But year to date, we're 10%. So a lot of times, our biggest job is looking at a particular story and trying to take the emotion out of it. So if we were to look at like the 5-year chart on the S&P 500, pre-election, that's November 1st, 2024. December 6th, that's kind of the euphoria of the market. Hey, we're going to tariff China, we're going to tariff China, but Canada and Mexico, not expected. Market sells off. January 10th. Well, we're going to wait. We're not going to tariff Canada and Mexico. Okay, let's get back in. Yeah, everybody's okay with tariffing China. Okay, we're actually going to put in 10% across the board tariffs. We're going to tariff China 120%. Canada and Mexico, where we get our timber and our drywall from, are going to do XYZ to our housing market. Solid. Oh, well, we're going to pause. We got a little over our skis a little bit about this tariff. Now we're here. But this is a lot of noise. If we go back 5 years, 2020, we're still up significantly. So this hurts. There's no denying this hurts. Going from 609 on the SPY, which is the S&P 500 tracker, to 527, that hurts. I can't say anything to anybody to make that hurt less, other than the fact that I would still rather be at 527 if I had known, to close out 2024, that would be at 467. If I had gone in a straight line, I'd be okay with that. right? Even going back to 2022, if I had gone from 470 to 527, I'd be okay with that. But that's kind of an emotionless, cold way of looking at it when maybe I made plans in my head, in February, I'm going to buy a boat because my portfolio is X. And now I no longer can because it's a Y, right? So that's why we encourage a lot of times people to let us know when things are coming up so that we can adjust their portfolios. And that's why sometimes you do get caught a little bit. Hey, I'm going to buy this rental house, next week. Can you start putting together a plan for me? And then this happens in the market. We weren't planning on you buying a rental house when we made the investment plan, right? There's an opportunity. It came up. We do our best to adjust for it. And kind of it's one of those things. I go back to this a lot. So back here, it's February of 2009. That's when, believe it or not, Henry, my oldest, was born. He's 16 over spring break for driving. So be careful if you see a Subaru with a lightsaber on the back of it, because he got my car. But that was scary. The market had dropped 50%. And, we didn't know at that time, was the economy going to survive, the subprime mortgage crash. Why go back to October of 2007? I would have been okay buying there. I'll take a 154 to 484 movement during that time period. In the long term, stocks are the greatest creator of wealth that we've ever seen for the masses. There are better creators of wealth. If you're able to start your own business and the Mark Cubans of the world sell to Yahoo at the exact right time. Yeah, they made billions. But for the masses, the best way to get to wealth has traditionally been the stock market or real estate that's been managed well, because those two things over time have done really well. But the access to the stock market is significantly higher, I would say, than certain things within the real estate market, just because you can start with $300, start with $100. And that's something that we work with a lot of younger investors on, is like starting out, because the time works. And that's where I feel like our role is. You all know me, I'll keep talking. So I'll try to shut up there.
You mentioned the younger investors that you had. How do you advise a teenager to inspire? So the Fidelity makes it more easy to do that. Is that something you guys?
So normally what we'll do, and I've done this for a lot of like Henry's friends, I'll bring them in, and I've got better spreadsheet than this, but I'll say, all right, well, let's say you get $500 for your birthday. We're going to withdraw $0. So we're not going to be withdrawing. I'll take this chart out much further. But then what I'll do is I'll say that every year we're going to add in $500. And what I'll do is I'll show them and say, you have the ability to be 100% in stocks. So what was that, 10.2%? Putting $500 in a year, 30 years, you can be at 104, right? And I'll run these numbers on that. And it's really interesting where, especially if you can get them in the habit of doing it monthly. And normally what I'll do is I'll have them pick something that they're interested in. So, it could, right now, the big thing for a lot of kids is Roblox or like Microsoft because it owns Minecraft, or Nike or something of that ilk. And then we try to blend that. We'd be like, all right, well, let's buy the stock market broadly and then buy something that you're interested in. And we kind of try to show them how easy it is as an 18-year-old or a 15-year-old to get to $1 million by mowing yards, right? Because push come to shove, a teenager can earn, $500 in a summer.
Now, a lot of the kids I work with, they have they really want to shape the world in a certain way already. And so if you can show them how putting a little bit in these early years gets them to 13 million comfortable by the time they retire, and say, this is the type of much that can help you shape your community to reflect more what you want. They love that. We had quite a few kids that come to us just because they were sharing that story and want to make the world.
And a lot of them, one thing that I'll do too, this is 30 months, so putting $100 in a month, which doesn't sound daunting to them. If I told a 15-year-old that for the next 3 years, put in $100 a month, that you'll have $38,000, in 3 years for college, for art, for Xboxes, for down payment on a house, for a car, And then what I'll normally do is, and I will tell them, you have the ability to take risks. So let's say you're Apple that has earned 25%. What does this number look like? If you're NVIDIA that's earned XYZ. And the more that message gets out, the better, because then they're not, pulling on societal resources that they otherwise would have. But typically, you say the word $1 million to a young kid, that means a lot. I realize $1 million means less now than it used to, but that still seems to be the boogeyman of things for young kids to be like, oh, I could be a millionaire.
I think the big knowledge get in front of you guys. When you show them charts like this, Wayne said this several times.
Yeah.
When you show them charts like this with a little bit of a little thing that they can do, how it grows.
Gross.
Society is they're not educated, they don't know how it works. And to show them the growth potential they have with a little bit at its own, it's an IB experience.
Right. And I think it's a big thing, exactly, the little bit that it takes. This is $100 a month for 3 years. Kid with a job's going to make $100 and still have money plenty to buy, other things that they want to do. So we're not saying that, hey, you have to be a plumper, for the rest of your existence to make this happen. This is achievable. It's the way, what Warren Buffett, compounding interest is the greatest force known to man. And so for a lot of kids, and we do a lot of work, both, a lot of times it's clients' kids, it's friends, family members. Ryan's done a lot of work with Boys and Girls Club, trying to get this, because Tennessee does require a semester of financial education. Really happy that they do that. It doesn't cover this.
But you still want to learn this summer and have to, if I
Yeah.
So it's not them age. Yeah.
I've got one who wants to get started. Should I get her?
Oh, yeah.
Yeah.
Yeah. And the earlier they start, the better. And the earlier you start for kids, too. We work on it a lot, too, with grandparents and parents. Be like, right now, a lot of it's, funding college education for parents and grandparents. But, you take this back to year 0 and you start doing $25 a month as a gift to your grandkids instead of Roblox or V-Bucks or whatever it is. Well, thank you all for coming today. Josh will get this up on the interwebs and all that fun source stuff, as he can put together, and keep on going. Have a good long weekend, and we'll see you out there.